So today's cardinal lesson, we're talking about long-term care slash life insurance hybrid. Like, what in the world is that? I mean, that's a bunch of words. So I think people know what long-term care insurance is. It's an insurance policy that pays if you need nursing home care, if you need assisted living, or where it's used a lot is at home health care. So where you stay at home, but you need care, and so you hire professional help to come in and they help you with the activities of daily living. Okay, and it's insurance that pays for that. So that's long-term care insurance. I think most people know what life insurance is, and life insurance is something that pays you, or actually it's not going to pay you, it's going to pay your beneficiaries after your death. And it's generally looked upon as a way to replace your income or to replace money that your survivors need. Most people don't look at life insurance as a way to transfer assets to the next generation. Is that people that are very well to do, most of them own lots of life insurance because it's a very effective and tax effective way to leave money to the next generation. Now you put these two things together, that's what a hybrid means, is that a hybrid policy or a hybrid does both things. So we're taking a long-term care insurance policy, we're taking a life insurance policy, and we're putting them together. So that's what the topic means. And today we're going over a specific policy that's coming from One America, from the state life insurance company. And there's several things that are unique about this policy, but the main one is you can use your IRA money or your 401k money turned into an IRA. You can use it to purchase the policy, or you can delegate it to purchase a policy. So one of the things about hybrid life long-term care policies, we have this from several companies, is that it works very well when you pay a single premium for it. When you take a chunk of money that you move it from where it is to an insurance company, and the money's still yours, and it's in a cash value in an insurance policy. But generally, that chunk of money needs to be money that you've already paid tax on, just savings, investments, that kind of thing. And with the clientele we work with, most of them just don't have $200,000 laying around that they could stick into one of these policies, except in their IRA. I mean, we work with a lot of people that have very large IRA balances. And they're also very concerned about long-term care. They're trying to plan out their income for the rest of their life. And they also have looked at long-term care insurance. And what they have disliked about that is, number one, is it's expensive. So they've looked at the cost that they have to pay every month or every year. And then furthermore, for their estate, they're just thinking, if I pass away without using it, nobody's gotten any benefit out of that. So this policy helps close that gap where you're either going to collect from it for long-term care, or your beneficiaries are going to collect from it after you pass on if you didn't use it for long-term care. So, and we're going over a specific example today, and which is outlined in the show notes. And I'd like to bring Tom on, and Tom is going to show us the facts behind this example I have laid out on the board.
Yeah, and so we have these show notes in the link below our video. You can also find them on our website, but it goes into a little more detail of what's on the board, and so give it a little more context here. And so we're going to scroll down here. That's like, I think it's the fifth page of the proposal here, where it really outlines this example that we have on the board. And so we're using a couple of Rick and Pat. Rick is 62, Pat is 60, so they're married, both in good health. And what they are doing is they're transferring $200,000 of their IRA money. So it doesn't specify, but let's just say Rick's IRA is we're going to take $200,000, do a transfer to One America, and it's at an IRA at One America. So that transfer is not taxable. That's you're taking it from one pot, putting it in another. It's still in your name. It's still his IRA. It's just now at One America. Now, what One America then does is distribute that 200,000 over 10 years into the life insurance policy. What they give you some interest on that. So the distribution is $24,000 a year over 10 years. So the total amount that's coming out of that policy is 240,000. But again, it's based off an initial deposit of 200,000, and there is you don't have any extra money you have to come up with. What you get for that is a death benefit of 230,000. So if they don't need long-term care at any point, their beneficiaries are going to get a death benefit of 230,570 to be exact. But if you do need long-term care, either one of them need long-term care, because this is a joint policy, it will pay a total amount of $6,917 a month per person. In this particular illustration, we've done it for life. It pays for as long as either one of them need long-term care. And so, what's nice about this policy is there is no situation where they could run out of benefits. Think of something like Alzheimer's or dementia. You could need that for several years, as long as potentially 10 years. And this policy will pay for that, and you're not robbing from the other spouse's benefit. And so that's kind of logistically how the policy works. Some of the nice things and the reasons we use this policy is it can solve several problems. I mean, one thing that 200,000, that transfer, is we are drawing that down over 10 years. The reason you wouldn't want to do it all in a single year is that would be a large tax bill to take out 200,000 out of your IRA to fund this. And so by spreading it over 10 years, that works with some of the planning that we do for some of our other clients.
Yeah, let me show you in this example, like what's really going on here. First of all, I want you to understand that with this one IRA transfer, you're actually buying two policies. One is a rollover IRA, and that rollover IRA is designed and will spit out 10 payments, and those 10 payments are exactly what the premium is on the survivorship life insurance policy. So you got a survivor or joint life policy covering Rick and Pat for $230,000. That'll pay off at the second death. And that policy has 10 premiums, and those 10 premiums exactly equal $24,000. And they come in over the next 10 years. They go from the IRA to the life insurance policy. And the IRA is specifically designed, and it's guaranteed that it will spit off $24,000 a year for 10 years, and then it will be empty. So after the 10th policy year, this IRA is no more, and all the money has been moved piece by piece over to here. Now, there is a wrinkle in this, is that this is going to show up in your income. You're not going to have to actually go make this transfer or pay any money because they've already got it in both policies, but you're going to get a 1099 every year for 10 years for $24,000. But that's spaced and much easier to deal with than $200,000 all at once. So this is how they've come up with a way to use IRA money to fund the single premium, because that's all the money that Pat and Rick are ever going to put in this policy, is that initial transfer of the $200,000. Okay. So now they're going along. If neither one of them needs long-term care for their whole life, Pat and Rick, and when the second one of them dies, their beneficiaries are going to get $230,000. And, I've had people ask me, well, what happens if we were killed in an accident or something, both of us? Well, is this all poof? No. I mean, this is going to go to if you have named your children, the beneficiaries, and anything that's left in the IRA is going to go to them too. It's going to be taxable to them. So they could potentially get more than this, but the whole design is for the life insurance to pay off at the end of the second life or the second passing of a married couple. And then the person who lives the longest, if neither one of them used long-term care, then this is going to go to their care, or they just used it a little bit. Let's say they used up 20,000 of it, then 210,000 is going to go to their beneficiaries. So if you use it for long-term care, you're going to be real glad you bought it. If you don't use it for long-term care, you're not going to know that because you're going to be deceased, but your estate is going to receive this money in the end. Okay? Now, let's talk about if you do use it for long-term care. And all you're simply doing is you can take out $6,917 a month, which is really your death benefit early. So you're just taking away from this $230,000 death benefit. And if you add this all up, you got 33 months of care for either Pat or Rick. So they could both be in there at once for, I don't know, 16, 17 months with the one. I mean, they could use it up. One of them could go in there for 33 months or use it at home. And then it's all used up once they reach almost 3 years. And you say, well, what good is that? I mean, going through my spouse's long-term care, use it all up at 33 months. Well, that's until we get to the extension rider. So once this is all used up, then included in this whole deal is a lifetime continuation long-term care. And this is the only company that writes this hybrid life long-term care that offers an unlimited or lifetime benefit that we sell for, okay? And so this is terrific because if you used up all the money in the life insurance and that's gone, so you don't have that benefit anymore, but what you have is a paid up lifetime. One of you could use it for 15 years or something. And so it's just, it has no limit on it. So that's why we can't really put a maximum on the policy. But once people understand this concept, they a lot of times they'll fall in love with it, because generally when people are in their 60s, that's the time they're coming to us. Some of them in their early 70s, some of them in their 50s. But that's the point where they're starting to realize with their IRA that now they got to start taking some distributions, and it's going to make a lot of sense to distribute, to get the money out in smaller pieces over their lifetime. So this is a piece of a larger plan with a lot of people. And we're showing you somebody, a man 62 and a woman 60, and a married couple. Obviously, if you're a little older than that, say you're both 65, you're either going to need to put in a little more IRA money to get this benefit, or you put in 200,000 and you're going to get a smaller benefit paid up for life. And we could run an illustration on that for just about anybody. All you got to do is call us and we can shoot this out to you or do some consultations. We'd always want to make sure that this would be, I would never want somebody, if that's the limit of what they have in their IRA, to dedicate their whole IRA and their retirement income to a hybrid life long-term care policy. This is intended to be a piece of it. We also don't need to purchase this large of a benefit. Some people do this with 100,000 for a couple, or 150,000. So there's a lot of different amounts. This can go as low as 50,000. Now, this isn't just for married people. So if you ran the same arrangement, but you just did it on one person, it's not going to cost 100,000 for one person, because there's benefits of the second to die, but somewhere around 130, 140, 145,000, depends whether it's the man or the woman, because women are a little more expensive than the man. Just women use long-term care more than men do. So if you go through this, you can purchase this same arrangement just on one person if you're a single person. And then it won't be a joint life policy. It'll pay at your death this amount to your beneficiary. And then the lifetime continuation would just be on one life. So there's a lot of different ways to work this arrangement. We're just showing you one of them. So now I want to go back to Tom, and we want to make a few more points.
Yeah. And so one of the questions we often get when people come in, we've shown them how this works, and they say, "Okay, I'm interested." We often get the question, "Okay, well, what triggers the benefits? What has to happen for me to start getting this 6,900 or 9,600 a month? Excuse me,
It's
or
6917.
6,917."
Yeah.
And so to trigger the benefits, it's really one of two things. Is one, and this is what most people generally do, is you can't perform two of the six activities of daily living. It defines that here, but if you can't do two of them, that would be a trigger for benefits. And then the second way, and it's good that they put this in here, is that you require care as a result of severe cognitive impairment. And so the reason they've put that in there is you could have a cognitive impairment like Alzheimer's, like dementia, not meet those other things. Like you could get, you could bathe, you could, get in out of bed, you could go to the toilet. I mean, you meet all those other things, but you clearly need someone helping you. So it's nice that they've added that cognitive impairment piece in there to cover those situations. But once you meet those benefits, that's what triggers the policy to pay out the 6,900 amount benefit. Some of the other things that we just want to kind of point out is when we're looking through the show notes have a lot of information here. It does define the different areas that you could receive care. So it's not just in a nursing home, it's assisted living, it's home health care. It's kind of all of the above, anywhere you could receive care. And then it defines some of the different benefits of the policy. But the other kind of thing to know, and where this comes important, is there is a medical underwriting component. So there are some questions they ask. This one isn't as strict as some other companies, but if you're sick, it could be harder to qualify for it. And so when we have people on the fence, they say, well, I might just wait a year or two to do this. You run the risk of something happening health-wise that would prevent you from buying it. So if this is of interest, you kind of want to move on it while you can still qualify and be able to get the benefits.
Okay. Now, I want to point out really 4 significant points with this particular insurance arrangement. Number 1, the premiums never increase. Everything's baked right from the beginning. And that is one of the call outs on the traditional long-term care policies, that in the past, there's been significant rate increases. I think that's mitigated quite well with the newer policies, but nonetheless, they still could go up. This can never go up. What you see is what you get printed in your policy will last forever. Long-term care benefits never decrease. So this $69.17 a month doesn't change for the whole time. There's cash value growth. So the money, you haven't parted with this $200,000, because right now it's not like it's in your pocket. It's at a financial institution, and you've rolled it over from that financial institution to an IRA at the new financial institution, which is One America State Life. And then it's still managed as an IRA. And then from that, they're moving $24,000 a year into your life insurance policy that also pays for long-term care and also has an extension rider. And then that's all building cash value over the years, and your cash value will grow. So again, the money's just in a different financial institution. It's not gone. And then the death benefits, if not used for long-term care, the benefits of the policy, if they're not used for long-term care, they're going to pay out as a death benefit to your beneficiaries. So that is very sweet. And something that we've just started to do is we really have 7 worries, as I outlined in my book, that are addressed in retirement planning. These are the 7 subjects, the 7 worries, the 7 categories, whatever you want to call them, that we address. And this one with long-term care touches just about all of them. I mean, yeah. And so I want to go through is that for starters with Medicare, this is addressed. We do a lot of Medicare planning, but Medicare doesn't pay for long-term care. I mean, it just doesn't. And long-term care is a whole category by itself. So we obviously address that today. IRA 401k, which is really the whole presumption of why we've gone to this product and why we offer so much of it and we sell so much of it to people, is because you can buy this with the asset transfer of an IRA and not have to pay taxes on it all at once. And out of the back end of the thing, you get long-term care insurance, which is terrific. And then we're obviously addressing income, because what really creates the need for this is that we're planning for income throughout your whole retirement. And you could have a time when your need for income doubles at some point in retirement, that you all of a sudden need an additional $84,000 a year, and you need that for several years. What asset are you going to go to? Well, if you have this insurance, you've already planned for that. It'll just come out of this. Estate planning, this is a life insurance contract, and we're going to do a within the context of estate planning, and also obviously income taxes that we went over today. So we hit 6 of the 7 worries today, and I very much want to thank you for listening. I'm Hans Scheil,
And I'm Tom Griffith.
and we'll see you next time.
Thank you.